factors that drove the great correlation were very low interest rates, which encouraged risk-on, risk-off behavior. When you have a bond portfolio which yields 8% or 7 or 6%, you're very reluctant to move it to risk-oriented assets. But when it's 2%, you're very quick to look to risk-oriented assets because you don't want to miss a big move. In addition to that, you had a period where you had very high macroeconomic uncertainty. Economic policy uncertainty peaked not in 2008, but in 2011 and 2012, when you had very high, you had 4 elections or 4 regime changes. Elections in the United States, elections in Japan, a regime change in the Chinese Central Committee, and European sovereign debt crisis, all of which threw policy into great uncertainty. Now the elections are over. Mario Draghi has promised to do whatever it takes, and you have greater confidence that the rule makers who are going to make the policies are in place. So, like it or not, policy uncertainty is now diminished, and there are actually measures of this that indicate that policy uncertainty is normal. At the same time, the forecasts, economic policy forecasts, which were very uncertain back in the 2011 period, 2012 period, have now petered down to a manageable level. So correlations had spiked, and now they've diminished. And because these policy changes have taken place, we feel pretty confident that the great correlation is behind us. That's good for hedge funds because hedge funds trade relative value. And in fact, you've seen relative value hedge fund returns go back to normal levels in the vicinity of 8-9% annualized. There are a few certainties in the investment world, but you can be certain that that great bull market in bonds is closer to an end than to a beginning. So with bonds yielding in the vicinity of 2.5% to 3%, large pools of assets have to find a source of returns. And by the way, you might add that there are risks in bonds today because if interest rates spike, that pushes bond prices down. Relative value hedge funds are a logical place to go for non-correlated returns. There are opportunities in risk arbitrage, there are opportunities in fixed income arbitrage, not directional fixed income. There are opportunities in equity market neutral, convertible arbitrage. And if people are willing to tolerate a little less liquidity than they got from a bond portfolio, relative value hedge funds provide a really interesting avenue for better returns.